All right, I got Erik at the Hedgeless Horseman with me today. What's up, Erik?
Well, things are good. How are you?
Doing well. How's everything look in the gold space?
Well, it's we're at an interesting point. I mean, when you look at the gold price, we're at really nice levels, 5-year highs, or yeah, basically above 5-year highs. But the miners are lagging big time, and I mean, even though the gold price is higher than 2016, I mean, the miners share no resemblance to their former selves during that time period. I mean, in 2016, you actually had miners really getting out ahead of themselves, like first Majestic, which ripped like 600%, 700% perhaps, and in my opinion, started pricing in silver being at $25 or above already. So, I mean, at that point in time, I think there was a big amount of greed in the market, and that greed found its way into the miners, obviously, which catapulted a lot of juniors up 300 to 600%. But when you look at the miners now, it's like they didn't even get the memo that gold is actually starting to break out of a 5-year long base. I mean, it blows my mind.
You know, we've been struggling to break through 1350, 1370 range for so long, right? That was the high from the summer of 2016. And I've been writing about this for a while. I always felt that once gold broke through 1400, it would pretty much declare game on to the market. And then you would have the masses interested and everybody would start piling on into these mining shares. But as we can see so far since the breakout, which happened, coincided the same day after the FOMC meeting in June, you know, that's kind of not been the case because although the miners have done really well so far this month, they just haven't caught fire like you mentioned back in 2016. And as a refresher for anyone who's kind of, whether you followed me on my blog or Erik through his website, we've kind of been in contact since, I forget if it's 2015 or 2016, but, you know, we were both around during that time period when the miners were putting in their lows. And then, you know, we got to experience that breathtaking move up from the 2015 lows into 2016, which, you know, it's kind of interesting to observe what's going on right now. And one thing I kind of wanted to point out is last time, you know, there was actually an inherent lag in silver. I don't know, Erik, do you remember that taking place where it's kind of more of the gold producers, the seniors kind of leading the way first?
I mean, it doesn't spring to mind, but at the same time, I mean, I was really new in the business back then, so I didn't have, you know, a good overview of the whole situation. I just knew that, okay, I like silver and gold. I've just basically got bitten by the gold bug, and I saw names like Silver Standard crashing 10% when silver was perhaps down 1.5%, something like that. It's like there was this huge overreaction in my mind, and I didn't know much. I just had basically a spreadsheet where I compared some of the valuations and what they would be producing and whatnot, and I just loaded up on basically everything in sight that had some sort of growth profile and looked cheap on paper. So I just bought hand and fist when Silver Standard crashed, and that ended up being a very good trade. And the same for example, Bear Creek. But I mean, my analysis wasn't that. I mean, I was far from being any kind of expert, and I'm still not an expert. But I just saw that as a, I guess, a sentiment low or something. That okay, this is totally bananas, and I'm just gonna load up because I mean these valuations can't hold, and especially if I mean the debt scenarios and whatever. I mean the basic overall thesis for even owning gold and silver, if that would play out. I mean I've just hit the jackpot buying miners at like 3-4 year lows and actually overreacting, because I mean I'm a value investor, I would say, and if the companies simply fall much more than their underlying fundamentals have decreased in value. That's just a buy signal for me. So when I saw them crashing so much more than silver, I just loaded up. I didn't draw any charts. I didn't have any trend lines because, I mean, these companies were breaking the previous bottom. So, I mean, from a short perspective, in hindsight, that looked like total carnage, and I mean, a huge bearish signal. But I just stuck to my guns and started loading up, and that, I mean, I guess I got lucky, but that ended up well. And then with as a year passed or so, when I had read up more about miners, I just rotated into basically looking for alpha plays instead of just buying Bear Creek because they have this huge silver deposit that might not be developed for like 10 years. But I didn't think about that. I just saw, okay, they get a huge deposit and it could be worth this on paper if silver's going to that level, for example. So, I mean, it was just luck, but I guess it was founded on just buying cheap value.
It looks to me anyway, you know, somebody who was heavily involved in the space 2015, 2016. This time around, it doesn't look like the lows are kind of as extreme. Would you agree with that point where we've had a correction to a degree, but the opportunity where you're kind of finding a lot of stuff trading at negative enterprise values or basically at cash? I mean, it hasn't really dropped to that magnitude. What would you say about that?
I mean, that's a good topic. I would say yes and no. On an absolute basis, perhaps no, that there aren't as many companies trading at negative EV. But at the same time, when you look at it in relation to gold, I mean, we're talking gold at above 1,400 versus gold near 1,050. So, I mean, from that perspective, I think actually that there are a lot of juniors out there that are more ridiculously valued than in 2015-16. So, I mean, that's basically my case for being all in, because I think the market is totally bonkers. And if it was bonkers back then, and some of the, or many juniors are just, I mean, they're still down 70%, a lot of them, from the 2016 highs. And sure, they might have overshot their value in 2016. But again, if you compare it to how much gold has gone up, I actually think there are a lot of names that are perhaps, I can't say they're more mispriced than negative EV, because I mean, that's basically an anomaly according to the, I mean, efficient market hypothesis. Nothing should be valued for less than zero. But anyway, but on the, I mean, in the bigger scheme of things, I think perhaps that this is even more crazy than in 2016.
I think I see your point there as it pertains to gold. That's one reason I've kind of started to load up on gold producers, especially ones, let's say they're not the highest margin, but they can, you know, actually make decent cash flow at, let's say, $1,250 gold. And, you know, once gold gets a re-rating at 1,400, if we can actually just hang out here and, you know, not crash all the way back down, there's certain companies, I think, you know, it's that window of opportunity that if gold prices hold up, then they can actually start raking in some really good cash flow moving, you know, forward as soon as, you know, this quarter and next quarter. With that said, this time around, it feels a little different to me, because silver it's still lagging, and, you know, to a degree it's lagging even more than 2016, since the gold to silver ratio is above 90 right now. And, you know, you said gold is 1,400. That looks great. You know, it's touching highs that haven't been seen since 2013, but silver is still below $16, and, you know, it's trading, I think, about 15.3 or so right now per ounce. Yeah. And it's just hard to imagine that, you know, these silver producers are going to be cash flowing to the same degree as, you know, if they were more primarily focused on gold. So it kind of makes a tricky situation, because as a lot of speculators know, when this stuff moves, silver stocks tend to lead the way. That's kind of happened again this time around, to a more mild degree. You still have outperformers like First Majestic that's kind of leading the charge, but, how do you approach it yourself if you know, for instance, the silver price is still really trailing gold to a large degree? Are you confident that's going to close the gap soon, or do you kind of position more so in your favorite gold stocks and kind of like reallocate, like you mentioned earlier, into silver at a later time, let's say once silver has its breakout?
I mean, that's a good question. I would look at it like this. To me, if you just base it on risk reward, I would say that my favorite, I guess, asset class right now is gold juniors, just because gold is so high, and especially since the juniors are so low, despite gold being high. And then I would say I love silver, just because of the gold-silver ratio, and it's still lagging at $15. So, I mean, there's an interesting dilemma there. Okay, you could buy silver juniors, for example, because I think the gold-silver ratio and the price of silver is unsustainable and is too low. But that's speculation, because you don't know when it's going to happen. You just know that, okay, it should be a slingshot move. And apparently some of the silver juniors have already perhaps started to move in expectation of that slingshot move. So, I mean, but if you base it on what we know now, we know that gold is high, silver is low. I expect silver to outperform, but that's still speculation because it hasn't happened yet. So, I mean, if you like the highest beta plays, and I mean to potentially have really outsized returns, sure, I can see silver juniors being the place to be because the gold-silver ratio is that high. And I think that's also an indicator of the poor sentiment, that the retail guys aren't really in it. But the institutions, etc., I don't think they buy silver because of, the Fed or Iran or whatever. I think they invest in gold, and I think that's why the gold-silver ratio is so high, that because the big players are loading up on precious metals, but they load up on primarily gold. And the traders haven't come into silver yet, I think, because, the short's been so poor. And we haven't seen that retail participation yet because of perhaps crypto and the cannabis stocks. Because, it's obvious that greed is near a peak, I would say. Or at least it was when Bitcoin topped. But I think it's very high still, just based on the overall stock market and Bitcoin coming alive again. So while they can make outsized returns there, they're not looking for silver, which has been dead for like 50 years. So I think that's just basically the problem, that the retail aren't buying this yet. And that's also why I think silver and gold juniors are lagging, because institutions don't go to silver primarily. They don't go to junior miners, which might be illiquid. So we need retail people to, either new retail people to come in with fresh money, or some profit taking in the producers and the high beta development place. Basically, people who are already in the space and are gold bugs who just wants to diversify or catch the next coming train. But that's I think the reason for silver and gold juniors lagging, because the mom and pop isn't participating in this move, because they're basically they're on the sidelines because they have so much fun to do in the cannabis and the crypto sector. But again, if you want the highest speculative risk reward trade, I would say silver and silver juniors. But as it stands now, I think for the more risk-averse investor, I think the gold juniors is a better place to be, just based on their being undervalued in terms or relative to the current gold value.
I think you make a really good point there, because especially 2016, Bitcoin was around, yes, but it wasn't as mainstream. It was, I mean, it's still, some would argue, still very nascent technology, blockchain in general. But I mean, 2016, you asked, a person on the street, they had never heard of Bitcoin. It hadn't caught fire yet. That came a year later. And cannabis stocks, I don't even think were around in early 2016. So it seemed like a lot of spec money moved into the miners relatively quickly that year. This time around, I would agree with you there, where it seems like gold is starting to catch a bid, and the leading gold producers, if we pull up a chart with, you can even just compare the ETFs. GDX is still outperforming GDXJ, which is outperforming the silver ETFs, SIL and SILJ. So, until that trend kind of reverses kind of the way we would expect, I would say, to be quite frank, like for myself, I'm still kind of favoring gold at this moment in time, and my own personal portfolio allocations more towards gold stocks, and particularly gold producers that can actually benefit from this re-rating, if you will, with a higher gold price. Because I see your point on the silver optionality plays. They can probably offer the highest leverage returns in a full-fledged bull market, but since we aren't there right now, I do have my own reservations, like loading up big time on a lot of these optionality silver plays that, for example, it's a solid project. It's got a lot of ounces, but, for all intents and purposes, it probably needs, let's say, $25 silver to make work. You mentioned Bear Creek. Another one a lot of people like is Alexco Resources. That's in the Yukon in Canada. And, it's just, if that mine doesn't get put in production, you can be stuck potentially, and this is on the downside of things, just holding onto a stock where it doesn't really seem to be a path forward. Even though prices are going up, they aren't really rising to a level where you can get the green light for production. So that's kind of my fear. So for my own, let's say, speculation thesis, I'm kind of more okay with giving up maximum leverage or maximum upside and kind of honing in more on, let's say, these gold producers that were making decent money around, 1,200 gold, maybe 1,250, 1,300, but at 1,400, it should really lead to a material re-rating, and that's kind of what I'm hoping to see. If you observe in Australia, you'll see a lot of the Aussie stocks have kind of led the way. They have outperformed Canada in, it's kind of, in some instances, kind of night and day. You see a lot of ASX listed gold stocks trading at 52-week highs or all-time highs. And, the argument there for the longest time was, the weaker currency in Australia was leading to a lot of this re-rating, because a lot of the Australian stocks are, based actually in Australia. So it's lower operating cost with the weakening, AUD. But, the same argument could actually be made in Canada, because there's a lot of Canadian gold companies, and, the USD to CAD has been, kind of more, shifted in the direction that's favoring the US dollar at the moment. But you haven't really noticed that same kind of outperformance in the Canadian gold share. So, you started to see deals as well. There was St. Barbara that came in and, put an offer to buy out Atlantic Gold. And I think Northern Star Resources was another one that's kind of, that one's been doing even better. That's at 52-week highs. I was looking at that the other day, and, they're starting to invest some dollars that they have, and, their script is really strong right now. So that's kind of the other way I'm playing it. Erik, what are your thoughts on mergers and acquisitions, takeover targets, stuff like that we haven't really seen since, the heydays of 2016?
Yeah, I mean, that's in one aspect. My investing strategy has evolved quite a bit during the last years, I think, because nowadays I'm not that comfortable owning one asset developers or whatever, because, I mean, at least in the foreseeable future, most juniors don't have the cash to put anything in production, except if it's a very low capex project. And most juniors don't have excellent backing and stuff like that. So you're basically hoping for a miracle in that case. And if you're banking on, okay, but they will be bought out. I mean, that's understandable from a peak gold perspective, or at least based on the poor project pipelines in many mid-tiers and majors. But at the same time, it's like, okay, what's the downside? They won't get bought out and they can't finance their project, and they don't have any other projects. So you're basically sitting there and hoping for, unloading it to greater fools. So that's, I'm very much concerned about exit plans nowadays. I limit my search to juniors with good backing, good management, who I know can access money. If they're an explorer and they have access to money, okay, that's fair game, because it's a high risk, high reward play. I don't want to own a explorer with bad access to capital, because then nothing will happen. And for the developers and such, you're basically hoping for that, okay, 50% buyout premium or whatever. I don't think, in my view, there aren't a lot of those cases where I think the risk reward is worth it, just based on the low probabilities of most juniors financing anything themselves or being taken out. Because if we get into a full-fledged bull market, and I'm left with, okay, they haven't been bought out yet, they still can't finance the project, okay, what's my game plan here? I just don't like that uncertainty, because I like companies that, okay, they have a very natural exit strategy. For example, either they are a producer, like take Premier Gold for example, they have a huge pipeline of projects, they are a producer. Minera, Alamos, I like that stock too. It's a pretty risky play, but they have a big pipeline, and they're low capex. So I don't see a problem for them actually creating value along the line, and just not waiting and crossing their fingers for a buyout, or hoping that some white knight or whatever will come along with a bag of money. So I don't know if that was such a clear answer, but I'm very hesitant in just buying stuff that I'm just... The question is not when, but it's if. I prefer companies where the question is when. Okay, when will this get up and running, or when will they sort this thing out? But if you have, if you have a fully fledged late stage development play just sitting there, who can say that it won't just sit there for another 2-3 years? And if they decide to, if they don't have a project pipeline and decide to, okay, we have to do something, so let's go out and get a new project, and then you're starting from scratch again. Then there's going to be a year of geophysics and soil sampling and whatever. I don't want to own a company who's doing that kind of stuff in a full-blown bull market, because there's like a bunch of companies with decent project pipelines who are possibly like 50% undervalued just based on where they are today in relation to the gold price, and they have a lot of exploration or development potential. So that's the stuff I like. And if you compare that to, for example, the silver juniors, they're often not even that undervalued relative to the silver price. So okay, you're not getting so much free money on the table, so you don't get that benefit of margin of safety, and then you have to hope that, okay, gold will go up and they will create value along the way. I'd rather buy something that's, say, 50% undervalued in my mind and it's got a lot of growth potential.
So are you saying you prefer companies more in general, that they have multi-assets rather than just focused on one? Your developer comment, as it pertains to needing a white knight to kind of bail out a company, that seems to apply mostly to, say, optionality plays. Do you still have that same feeling if we're talking about, let's say, some developer with a very high quality project that can get financing and advance by itself into production and doesn't necessarily need somebody to come in for a takeover? Does that your same thesis apply there, or would you kind of scrutinize things more along the lines of, you're talking about the most optionality plays where, they could be left with stranded assets?
Yeah, mostly optionality plays. If we take for example, Pure Gold or something like that, they have good backers. They just did financing. Okay, it wasn't the prettiest one, but that goes to show that they have access to capital, that insiders and people close to insiders, they actually believe in the project to cough up 33 million or whatever it was. And I'm trying to think of someone else. I can't come up with anyone else right now, but I mean, there are some that, have the firepower to actually pull through. And Liberty Gold is another example. That's also a Markov Day play. And companies with majors already having a stake. I mean, those are really good signs that if they're not there yet, they can become a takeover candidate in the future, and the buyer is already lined up. What I don't like is the big optionality plays with a capex of 400 or 500 million. They're sitting with 5 million cash or something like that, and there's no obvious buyer lined up because there's too much competition from the more quality companies out there. I just don't like that anymore. I used to do it in 2015, 2016, but I didn't know any better. So I mean, those can provide the biggest rallies ever because they all of a sudden are worth 1 billion on paper, but you're still hoping for someone, a greater fool, to buy it off of you. And there's no basically margin of safety, because if the gold price or silver price crash again or whatever, they haven't created any value. They're no closer to being bought out. They're no closer to developing their assets. So I just don't like those chances when there's so much quality on sale.
You're pertaining to, I mean, I'm just throwing out some examples out there, but one that comes to mind that could do really well in a full-fledged bull market would be something like Midas Gold. We're talking whether it's 250 to 300K ounces per year production, but again, like you mentioned, that CapEx is really great. And even a company like Midas actually has strong backers. They're able to raise a lot of capital. You still need, an enormous amount of initial CapEx to put that mine into production. And I think they still need to actually go through permitting. So that's I think we're aligned there, where I don't really want to wait around for something like that to play out. And you really need, probably even now at 1,400 gold, you probably still need higher prices than that to really spur up that interest where, let's say a larger producer wants to take it over imminently, because it's still kind of rather marginal even at 1,400 gold. I mean, who knows how much higher you need to climb from here. So I've actually focused on companies you were mentioning, for an example, like West African Resources, where, I'll say their mine financing probably wasn't on the best terms. They raised pretty much at the bottom of the market around late 2018 timeframe, but they got it out of the way. They were able to forge a path forward. They got the debt financing that they needed, and they're actually in construction right now, and that's gonna be, I think, commissioning around this time, Q3 of 2020. And if you look at the project, it's pretty solid across the board. It's I think the first year production is going to be over 200 to 300K ounces just the first year or so. And, with all-in cost, all-in sustaining costs, I think sub $600 early on. So you kind of have those stories that you could have a rapid payback, and, there's still exploration potential in that sense. So, while you're developing and, commissioning a project, if you have high margins, especially at, these elevated gold prices, then, you can get a lot of the cash flow, and then you can kind of, simultaneously, while you're trying to get the mine to nameplate and everything, you can start, exploration, and, there's probably still brownfield stuff. You look for companies that perhaps have a flagship, but then they also have grassroots stuff, maybe even in a different country. And this is kind of a good segue into a company we both used to follow a lot, which was Orca Gold, where they have the flagship in Sudan, but then they also that's Block 14 project, and then they also have Morando, I think it's called, in Ivory Coast. So it kind of gives you multiple irons in the fire to play with while one's progressing. You can kind of at least have something to keep the market interested.
Exactly. I mean, the market, okay, it's supposed to price in the future. I don't think it, in a lot of cases, doesn't even price in the current state of affairs. But anyway, I mean, I'm on board with that kind of thinking, that you always want to have something to basically entice investors about, okay, there's more coming. And if you get a high margin project up and running, like West African, for example, I mean, you then have the firepower. If prices or gold prices stay around this level, I mean, and they're churning in a lot of cash, so I mean, they have the option to expand and buy up stuff that's cheap now and just add to their pipeline, like the Australians are doing. Basically, they're using their huge margins to just fill their pipelines. And what was that company that took a stake in Orca Gold, for example?
Resolute.
Resolute, yeah. I mean, they have stakes in a bunch of juniors. So they're just plowing they're spending a lot of money to get a foothold into a bunch of juniors in Africa or whatever. So, I mean, I really like that strategy because, I mean, okay, there will come worse times or maybe they have trouble at a mine or whatever. But, I mean, they've sown the seeds already. And I like that aggressive stance. And it's like, it's the same for basically Premier Gold. They have a bunch of projects and they're aggressively exploring pretty much every one of them. I mean, it's a bit of a risky strategy because they only have one producing mine, but I mean, the payoff could be huge. And I like these companies who are actually, I mean, capable and have the courage to be aggressive in during times like this, while a lot of crap juniors, they don't have money, they don't have the project, they don't have the whatever. So, I mean, I don't want to buy, I'm not that keen on buying like theoretical ounces, for example, now when you can buy ounces in the ground very cheap. And I mean, I made a post a few weeks back, I guess, where I talked about this and I highlighted Marathon, for example, as a standout example of how cheap you can buy success at this point, even though there are no guarantees that the Valentine project will get into production or be taken out. I mean, it took many years, tens of millions of dollars, and you needed to be successful, which is a rare thing in this business, to end up where they are. And they were trading like, I mean, not that far off from some pure hopium stocks or stocks that had perhaps one decent drill hole or whatever. So I mean that's lunacy in my mind. So I mean I don't own it personally, but it's been re-rating now at least. But that's like the kind of thing I don't think the market or we, and that includes me, really appreciate how rare success is and what it should be priced in relation to or relative non-success or potential success. So right. That's the kind of thing. I think the market is a lot of times totally irrational. I mean, if you have these valuations for people who have hit a home run basically, which one in 1,000 juniors will be able to accomplish themselves, and they're not trading for, I mean, many times more than these penny dreadful hopefuls or whatever. I mean, that just goes to show that either one type of company is severely undervalued or the other one is severely overvalued or both. And I just think that's basically, I mean, it's incredible. And just the fact that, okay, the low-hanging fruit have been plucked in terms of exploration in the well-known areas, in the well-known districts. So, I mean, we have fewer and fewer success stories. I mean, everybody knows about Aurelian, but that was like, 10 years ago. So, I mean, if that's how hard it is to find one of these Tier 1 deposits, and you can buy a Tier 2 deposit pretty cheap, what does that tell you about how the most exploration companies should be valued? They should be trading near zero in EV basically, because I mean the odds are increasingly against them, and the few success stories already out there are still cheap relative to, I mean, what it would take for an exploration company to have, first of all, that luck and success, finance it, go through every step of the way to reach the point of, let's say, a late-stage developer. I mean, it's years. It's years, tons of money. You need extreme luck. I mean, it makes no sense, but I mean, hey, it's the market.